Hello and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends that we have been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm your host, Tom Perks, an investment manager based out of our Birmingham office. And this week, I'm delighted to be joined by regular podcast guest Richard Carter, our Head of Fixed Interest Research, and Nick Wood, our Head of Investment Fund Research. Good morning to you both. Richard, as we normally do, I'll start with you first, and we'll have a look at the macro trends that we've been seeing here at Quilter Cheviot. And I think it's fair to say it was a bit of a quiet week last week with regards to the data, but still a couple of talking points for us. Firstly, the US ISM numbers, which were out on Monday, and they made for pretty grim reading. Seventh consecutive month where they've been in contractionary territory. And, you know, looking back, other than a short blip in 2020 during the early stages of the pandemic, we're now seeing readings that we saw in the years following the global financial crisis. If these don't improve, then surely we're staring down the barrel of a recession, aren't we?
Potentially. I mean, you know, it's fair to say that some of the data, you know, particularly last week, was a little bit on the soft side, and I guess we shouldn't be too surprised, right? I mean, we've seen these sort of massive increase in interest rates over the last year or so you would expect to see some kind of softening in the data, but I wouldn't say it's been too bad. The one area that's certainly holding up pretty well at the moment is the labour market. So actually that still looks pretty strong, still looks pretty tight, which is why the Fed may not actually be done raising rates just yet. We'll have to wait and see on that. But there clearly is, you know, increased expectation of a recession in the States as the year goes on. But I don't think a lot of investors are going to believe it as long as we're getting sort of very strong non-farm payrolls numbers. I think that's really the one we've got to watch. When that starts to weaken, I think people's kind of belief that a recession is on the cards will sort of increase. But for now, there are some doubters who think, you know, we will just continue to carry on a reasonable steady growth rate and avoid a hard landing. We'll have to wait and see on that.
Yeah, that's quite interesting because this sort of soft ISM data was pretty hot on the heels of some pretty strong employment data only the Friday before, just the weekend separating the two readings. And I think just off the top of my head, it was almost double what the market was expecting in terms of the non-farm figures. So there's been a lot of talk, hasn't there, about what kind of a recession, if any, we'll get, a hard landing or a soft landing. You know, we're all hoping for ideally no recession, but if we're going to get one, then we'd rather have a soft landing. Do you think that there's a possibility that the strong employment data and the weaker manufacturing data could actually cancel each other out and we end up coming out of this okay?
Possibly. I mean, I would say that, you know, looking back at history, the sort of PMI's manufacturing data are more leading indicators and job numbers are lagging indicators, and normally it's the last thing to go. So, I mean, I can understand why, you know, people look at the jobs data and say, you know, companies aren't letting workers go. They're still hiring. Things are still pretty good. And as I say, that's something that's pushing the Fed potentially to raise rates by further. But I would stress that the jobs numbers are normally the last thing to go. So I think it's possibly, you know, when you're looking at leading indicators like PMIs, like also credit conditions as well, things like that, I'm afraid those don't look quite so good. But yeah, as I say, the jobs numbers are still holding up.
Okay, thank you. Moving from the world's largest economy to the world's second largest economy, we saw some pretty soft data out of China as well last week. A 7.5% year-on-year contraction in exports. Import data also missed estimates. So I think the question I have is that, you know, we were all expecting this pretty seismic rebound in economic activity coming out of China with the reopening at the end of 2022. Is it a case of that's failed to materialize, or are we being a bit premature and we need to wait a little bit longer for that to actually feed through to the wider Chinese economy?
I mean, it's a good question. I mean, I think we have seen a bit of a rebound, but I think everyone got their sort of hopes up massively that we were going to see some sort of huge jump in Chinese activity, and the Chinese stock market would be off to the races very quickly. And I think it hasn't really lived up to expectations. I mean, what you mentioned about exports last week, that they were disappointing, but often, those are reflecting more what's going on around the world and kind of global demand for sort of other Chinese products rather than necessarily what's going on domestically in China. And certainly, but certainly the fact that global growth is a little bit sluggish in some areas is not helping the Chinese recovery. The other thing, in the sort of past, the Chinese growth would be driven by lots of investment, lots of infrastructure, building airports, railways, all the rest of it. Times have moved on; they're not looking to do that these days. It's more of a sort of domestic, retail-driven, economy. And maybe perhaps you're right. Perhaps we do need to give those sorts of things a little bit longer to work. So, I mean, I think what we can look forward to in the next few weeks, the market's certainly starting to think about this, is that if growth is too slow in China, the government will get a bit nervous that they're going to miss their growth targets, right? So we could see some sort of stimulus, either lower interest rates or other measures from the government. But certainly at the moment, things aren't turning out as people had hoped.
All right, interesting. Thank you. We'll move a little closer to home now, and certainly Friday was another interesting day in UK politics, with Boris Johnson once again the sort of centre of attention, as he likes to be. So obviously Boris handed in his resignation on Friday. Similarly, a slightly less renowned politician, Nigel Adams, did the same, joining Nadine Dorries, who'd done so earlier in the week. I don't think these three resignations will have a huge impact upon Rishi Sunak and the Conservative Party, but what we are probably going to have is 3 by-elections, most likely probably on the same day. And do you think that markets will actually be paying quite a bit of attention to these by-elections, because it could give us an insight into how voters may well vote in the upcoming general election?
Yeah, I think so. I mean, it's interesting, the weekend sort of news, Boris Johnson quitting as an MP, and now obviously Nicola Sturgeon's got her own problems as well. And it kind of seems like the people who have been at the forefront of the political world the last few years are kind of exiting the stage, and you know what I mean, and things are moving in a different direction. I think a lot of the country and politics in a way has moved on a little bit from Boris Johnson, and won't be too affected necessarily by what's happening to him personally. But I mean, in terms of the by-elections, yes. I mean, you never quite know with some of these different individual seats how much you can then extrapolate that more generally into sort of the key marginals that will be kind of contested when the election finally comes around. But I think, certainly there will be attention paid to it. Still potentially some time to go to the election. I mean, it's difficult to know exactly when it will be, but potentially September next year would be my guess. And I don't think the big picture has really changed. Rishi Sunak seems to be kind of a safe pair of hands. He's trying to deal with all the various problems that the country's got. But so far, he's not got much political credit for it if you look at in the polls. And unless he's able to change that, then looks like we're going to be heading for a Labour government probably at some time later next year.
Yeah, it's interesting. Having a quick look at the constituencies, they're all fairly sort of safe, what you would probably classify as safe seats for the Conservative candidates. So, I don't think anybody's probably expecting them to lose these seats, but a decent swing sort of towards Labour or Lib Dems in either of those seats could be, extrapolated for the country, for countrywide, really, couldn't it?
Yeah, absolutely. But it should be quite interesting. I'm sure Rishi Sunak, as I think he's been doing today, doing his best to distance himself from Boris Johnson. So it's going to be interesting to see if the rest of the Tory party fall in behind him.
Yeah, I doubt that this upcoming report is going to be a glowing endorsement of his time as Premier. That's for certain. Before we move on to Nick, just a quick word. on the Fed, because this week probably the main event really of the week is the upcoming Federal Reserve meeting. Will give us an idea of what the Fed are going to do with regards to interest rates. Now, I think we're probably expecting a pause in interest rate rises, but then what we saw with the Bank of Canada and central bank in Australia as well, slightly unexpectedly raising rates. Is there a real possibility that the Fed could also do the same and the market be caught offside a little bit?
Yeah, there is that risk, and I think actually some of the there are still some investment banks out there and forecasters who think the Fed is going to raise rates this week. We'll see. Personally, I think it makes sense for them to pause. They've inflation's been coming down. They've raised rates a lot already. Some of the data's been a bit soft. Why not take it? A wait and see approach and see how the data develops. But I mean, we do also have inflation numbers out in the States this week. So if they're a stinker, then that might change things at the last minute. But you're right. You could say the same for Canada and Australia. They would have been expected to take a pause and let the data develop, but decided to crack on and raise interest rates anyway because they're still worried about inflation. So it's possible the Fed does the same, but I think markets gearing up for a pause, and then ECB or European Central Bank likely to raise rates as well this week. So lots going on. Yeah,
all eyes on the Fed on Wednesday evening. Thanks, Richard. That's great knowledge and insights as always. I'll move on to Nick now, who's been patiently waiting in the wings. As mentioned, Nick is our head of investment fund research, but he also specialises in Japan and is responsible for our fund strategy in this market. And it's Japan that we're going to be talking about today. So, Nick, hello there. Nick, from an investment manager's perspective, Japan hasn't really been a region we've got overly excited about, particularly maybe over the last 5 years or perhaps longer. But it's an important market. It sits as a sort of a standalone region. It isn't consumed within a sort of wider continental market like, Europe or Asia or emerging. And it really has been in the headlines a little bit over the last couple of months. Performance has been very, very strong, perhaps one of the strongest performing markets out there. So can you tell us what's been going on and what's been driving this mini bull market in Japan?
Yeah, sure, certainly, Tom, and thanks for having me on. You mentioned there Japan being its own region. It sort of reminds me if you went all the way back to the Japan bubble, you'd have found Japan was about 45% of global indices, and well above the US. So it's a long time since then, and to be honest, it's been a long time since we've had quite so much interest. So Richard was talking about China earlier, and all the excitement was about the China reopening at the start of this year. But what we've seen actually is Japan has been the star performer. So UK investor, in sterling terms, you've got an 8% return from MSCI Japan. Actually, if you're a Japanese investor investing in yen, the market locally is actually up 19%. So it's been a really strong performer. There's always lots of factors that go into sort of driving a market. But I mean, two I'll pull out here that are interesting. Firstly, I call it the Buffett effect. So about 3 years ago, Warren Buffett took his first stake in Japanese companies, trading companies, and April this year he stepped off a plane in Tokyo and declared he was buying more, and I guess that does get market participants excited for obvious reasons. So that was one factor. The second one's a bit more technical actually. So bear with me slightly on this one. So I mean, I think everyone would agree Japan has looked cheap for a long time, and there's a large number of companies that trade below their accounting book value. So the value on the stock market is worth less than their accounting book value. They have a price to book of less than 1. Now, the Tokyo Stock Exchange has recently firmed up some rules whereby if a company wants to retain its status in the prime index, it's got to outline some plans if its price to book is less than 1 of how it's going to get that valuation up. So, essentially, the threat is if your valuation remains so low, we will remove you from the index, and so that's caused quite a lot of companies to start outlining plans in terms of how they're going to do that. And so what might they do? Well, it might include buying back stock. It might be paying out special dividends, increasing dividends. There's also quite a culture in Japan of cross shareholding. So a Japanese company, it might have a holding in its customer or vice versa, its supplier. It might, banks might have holdings in those they provide loans to, and vice versa. So these cross shareholdings are quite a feature of Japanese equity market, and selling these down, reducing these cross shareholdings is another feature. So that's got a lot of, I speak to a lot of Japanese equity managers, ones we're invested with and one not, and I would say I haven't seen quite the amount of excitement as I've seen about this measure for a long time, and there are some real examples of companies making these moves and their share prices sort of appreciating. So those are the two sort of key factors, but it's certainly driven more interest in Japan than I've seen for a good while.
Yeah, really interesting. Some really good points there. What about the currency? You mentioned there the divergence in returns for a sterling-based investor and a domestically based investor in Japan. So what's the yen been up to recently?
Yeah, well, I mean, it's at the opposite end of the spectrum, actually. So Japanese market's done well. The yen has continued to weaken, and it's on multi-year lows at the moment. And mostly you compare that to the dollar, but equally sterling. Sterling is relevant for us as UK-based investors. Why is that? Well, we were talking about the Fed earlier and interest rates in the US. Well, the Bank of Japan has kept a very tight rein on bond yields. So if you take the 10-year Japanese government bond, it's pegged at 50 basis points, and if you just compare that to the UK and US, such a disparity there. It's clear why it's more attractive to invest overseas as a Japanese investor, or why not to buy Japanese government bonds. Now, the question is today, is that policy going to change? We've had a change in the Bank of Japan governor a couple of months ago. Inflation is coming through in Japan in a more measured way than elsewhere, and really, there is an expectation in the coming months that maybe that peg might move, that the bond yields will move up, and that will have an impact on the yen and potentially strengthen it. That might have a negative impact on those exporters in Japan, but I think as sat here as a UK investor, if you own investments in Japan and the yen strengthens, that's going to result in a stronger return, most likely for you as a holder of those Japanese assets.
Excellent, that's great. Thank you, Nick. So looking ahead, what do you think the prospects are for Japanese economy and the Japanese stock market over the next 12 months?
Yeah. Well, there's a lot going on in Japan right now. We've talked about sort of a couple of areas there. Inflation's another interesting topic. I just touched upon there, but it's one of the few countries where inflation is welcome. So if you think about the last 20, 30 years battling deflation, it means wages have been stagnant across that period. It means companies haven't put up prices, and so the Bank of Japan has been aiming for 2% inflation for an extended period. Well, we're now in the sort of 3 to 4 range, around about 3% at the moment, and it means wages are going to begin to go up. There's an annual round of wage negotiations that have just taken place, and a 3.5% rise in wages for employees within that remit. We've seen companies begin to put up prices, and that all oils the wheels in a positive way, at least compared to sort of a deflationary environment. Talk about cash on Japanese corporate balance sheets made a lot of sense in deflationary world. That was if what you're going to buy tomorrow is cheaper than today, then cash is a good investment, and the same for retail investors. But with a bit of inflation, that begins that dynamic begins to change. So I mean that's one positive. I'd say bear in mind where Japan is post-COVID. it's it's in a position now a little bit behind us, but in more of the reopening phase, and I think that is also a potentially a positive for the economy as a whole. I think a couple of things to think about, though. Let's not be entirely positive about this. So on the one hand, you've got a region that's done very well already. It is still a cheap market, but I told you there's a 19% return we've seen year to date already. And I think the other one is there's been plenty of false storms in Japan, and investors have been right to remain skeptical historically. And the question is, have the things I talked about today, are they really going to result in a change? I'm of the view that this is a much more interesting time to be invested now. But you should always be aware of as an investor that looking back in terms of recent years, there will be plenty of somewhat scarred investors who just haven't seen the returns that have perhaps been promised. So interesting times, and certainly whilst a smaller part of the global indices these days, it's still a region worth taking a look at.
That's brilliant. Thanks, Nick. And perhaps us investment managers here at the Coalface shouldn't be so dismissive of Japan in our portfolios moving forward. Sounds like there's a compelling argument there for the region. So that concludes everything for today. So I'd like to thank you both for those great insights, and I'd like to thank everyone for listening as well. Did you enjoy our discussion on the podcast today? We'd love to hear from our listeners, so please review the show now wherever you're listening and share it on your socials and tag us at Quilter Cheviot. To make sure you don't miss a future episode, tap the subscribe button. We'll be back next Tuesday. In the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or on our social media pages. Finally, I am pleased to confirm the FT Advisors Service Awards are now open. We put advisors at the heart of our business and would be delighted if you could vote for us via their website. Voting closes on the 30th of June 2023. And that's it for today. So thank you to Richard and to Nick for your time, and to all of you for listening. See you all next time.